Hey, Tim Russell here. Welcome back to the Multipart Finance podcast. This is the third episode that we've shot, so we've called it episode 3, but I'm releasing it to you guys as I guess it's really episode 2 because today we're talking with Scott Malcolm. He's the director of Money Mechanics, which is a financial planning business based in Canberra and Melbourne. He's got 2 offices there. Today we're focused on interest rates, so it's quite timely given that tomorrow the RBA is going to announce where the cash rate's going. Most people think it's going to go up. We've seen significant changes in fixed rates over the last 6 months. We think variable's probably going to move the same way. How much is it going to increase by? We're going to discuss all that and the mechanics in the back end as to why this is happening. Scott's going to talk about inflation and bond markets, etc. So I think it's going to be really valuable for you. Now, I will say we had a bad internet day. Some of this recording is a bit choppy, but hopefully enough content's there that you like it. Let us know what your thoughts are. Leave a comment, share it with your friend, and I hope you enjoy the video. Hey Scott, hey Ev, how are you guys going?
Good, Tim.
Fantastic. How are you, Tim?
Very well, very well. I was thinking, as we're having this conversation, probably in hindsight, we could have done it after tomorrow, where interest rates will be announced where the RBA is heading. But that's sort of what we're talking about at the moment. Scott, we might just start by you just introducing yourself and your business, which will probably make people aware of why we're speaking with you today.
Yeah, great. Hi, I'm a financial planner, and I often say to people, don't hold that against me because financial advisors often get a bit of a bad rap out there in the market. But we do a lot of education and financial well-being and training programs for people just to get them to help understand the money stuff. Like we're born into this financial system, and often say the commonality we share is that we're human beings, and we all then have to learn how to navigate the system. So I get really passionate and excited about just helping people to understand and unpack the money stuff. So great to be here.
Thank you.
Great to have you.
Yeah, and I should say, Ev, the reason for the connection is you go back a long way with Scott. So back in your previous days at Macquarie, you guys were working together. Is that right?
Correct. So Scott was actually one of my clients when I was working as a business development manager at Macquarie Bank. And when you've gone through a GFC together, you are stuck for life. So it's been an amazing journey, but through that, I've made an amazing friend in Scott. And we also went through 2 years of COVID lockdowns together. So there's been a lot of online gin making together. And we also lived probably less than a kilometre apart. So yeah, so Scott is an amazing person who's super passionate about what he does and has so much knowledge in terms of navigating through all of the crazy stuff that we've gone through in the markets.
Yeah, fantastic. Well, Scott, with property, we've gone through this period of coming out of COVID, and I think some people thought the markets would not go that well, but they've gone really well. And now it looks like we're moving into a new period where there might be a reduction in prices and interest rates are climbing up. We've seen significant changes with fixed rates, and being mortgage brokers, we don't really understand the mechanics behind the scenes of how all that stuff works. So we saw reports last week that inflationary figures, I think it was like 5.1%, which was the highest since 2009 or something. But just in terms of variable interest rates and how the RBA sets them, do you maybe just want to explain a little bit about how they do that and what's happening right now?
Yeah, and look, often all this information is a bit of a back test. So they're using past information to try and sort of predict the future a little bit to say, right, what's happening in the economy? What are we worried about? And so the inflation numbers that everybody's been talking about being sort of 5.1% inflation, that is above what the Reserve Bank likes to have as their sort of developed country inflation rate. And I think they like to track that around the 3% mark. Now, I'm no investment banker, so I'll throw to Ev if I need to, based on her past life. But my understanding of what they then look at is, okay, what's happening in the economy, what's happening in markets, and then do we need to make decisions around what we're seeing the base interest rate at? And to be very clear, that base rate that the Reserve Bank sets is actually very different from the rates that you get when you roll into Commonwealth Bank or Macquarie Bank, or which other providers do I need to promote that you use a lot? But any bank that you basically will walk into will have a very different rate to that base rate that the Reserve Bank uses at the end of the day. The other thing I just wanted to add there is after a big period of stimulus. So we saw it with the global financial crisis, where governments probably took a little bit longer to respond and react to what was happening in the market. But when COVID happened, and Ev, you can probably jump in as well, I've never seen the government actually react and respond so quickly before in my career. Been doing this since 2001, and they basically came in straight away with, here's money, everybody calm down, there's money, keep spending, keep doing what you're doing. Every time they stick on me, there is always a bit of a inflation uptick on that front. So anyway, I'm talking still. Ev, what do you think? Like you've obviously seen some of this stuff as well.
Yes, I have. Yes. So I'm still waiting for my $250 from the government to come into my account. Wasn't that supposed to hit our accounts last week? Yeah, so the way that the banks are, well, the Reserve Bank is basically the entity that sets the cash rate, and the cash rate basically is what it costs other banks to borrow money, and based on that, the actual lenders will add on their profit margins, what they want to do, and that basically determines the interest rates that you and I and everybody else in the market sees. So it's not something that the banks themselves control. It is by the Reserve Bank, which is independent of all the other banks. And sometimes people think that it's also controlled by the government. No, it's actually an independent entity that does that.
Yeah, it has been interesting watching the election campaign, and yeah, one party in particular has been very, like, every time they're questioned about the economy, that no, well, the Reserve Bank is a separate entity. We don't want to be seen as impacting their decision making. So yeah, that's good to note as well.
I'll throw it to either of you. I think a lot of people are surprised with inflation going up because, you might think that we've gone through COVID and a lot of people have struggled during that period, and typically interest rates increase to slow the economy down. What do you have any idea why inflation has gone up over the last few months?
I've got a world according to Scott, Tim. I'm always happy to share world according to Scott. Look, and interestingly, if you look at the breakdown, so you can, if you've got numbers geeks who are listening along today, jump onto the ABS website, so abs.gov.au, and actually shows you a breakdown of the main sectors, but then also a state by state basis. And so, interestingly, WA led the states on the upward sort of push of inflation. And so my view is that, again, they just came out of lockdown. So I know it hasn't really been locked down. If you have got any WA viewers watching or listening, they'll be, we haven't been in lockdown, Scott. But technically, the economy just reopened. And so, of course, there was going to be a bit of an uptick in their inflation numbers for that last quarter, because during that quarter, their borders opened, they started coming back online with tourism and some of those things. The other bits and pieces around that we've seen is a war going on in Ukraine, and that's sort of impacting Europe, and then supply chain. We've also seen with, say, Shanghai and I think there's even now talk that other big cities in China are going to go back into lockdown again. And so when we're in a global economy with global supply chain, the goods just getting to us, like we've seen it with cost of building supplies, we've seen it with the microchips that are in all our goods and services these days. And so that supply is not there. And so in the sense that we get given money by the government, so all that money comes in to say, yeah, everything's okay, keep spending, you're doing okay. And then when we do what we're told and we go and spend the money, but then when the goods aren't there anymore, that's where those inflation pressures come, because it's like that supply and demand thing where cost will then go up where there's lack of supply. It happened when COVID happened. I was one of those people that had a stockpile of Costco toilet paper. at the time, and then we had about rolled into the local Woolies, and they were like, no, you can only buy 2 packets. But then instead of being, I don't know, 10, 15 cents a roll, they turned out to be about $1 a roll. And I'm going, this is ridiculous. But yeah, anyway, sorry, I'm talking a lot again.
I think when you see the price of lettuce at $5, you need to start worrying about what is going on. And I think it's not just normally when people don't realize, I guess, the impacts of inflation until like they really do go to the supermarket, and all of a sudden the things that you would be buying at, $3 a kilo, $11 a kilo. Like literally my children eat about 20 cucumbers a day, and cucumbers at Coles yesterday were $11.99 a kilo. So it's not until you see these types of real figures that I think inflation starts to make an impact on not just what but also how you're then going to be able to manage it going forward, and having that certainty of how you're going to get your paycheck to meet all of your needs. And then if we're going to add an interest rate increase on top of that, I think that's going to see a lot of people really start to hurt. But from our perspective, it's really important, I guess, in terms of getting our clients to understand what they can control and what they have in their power to be able to manage through these different and difficult times.
Yeah. One other thing I was going to ask you, Scott, is so in the mortgage broking model, last year was the year of the refinance. Rates were the lowest they've ever been. Fixed rates in particular were lower than variable for most of the year. And then the last 6 months has been a bit of a nightmare for a lot of clients who were refinancing, in that I would say maybe since October last year right up till now, fixed rates have continued to jump up. And I don't recall a difference in fixed rates going from one particular rate to another. I'm just spitballing here, but I would say like a competitive 2 to 4 year fixed rate last year at any point in time was like 2%, and it's now high 3s. So it's sort of nearly doubled in this period of time, in the space of 6 months. Now, I know, broadly speaking, a misconception that clients have is that fixed rates is the bank's guessing where rates are going to be, and you could argue that as variable increasing, maybe they are guessing where rates are going to be. Now, I do say to clients, because I've heard this, but not with a lot of knowledge, but I say that the fixed rates move independently of variable, and they're based off bond markets, which I know to be correct. I don't really know exactly what that means, Scott. So, just in terms of fixed rates and how they're linked to bond markets, could you just explain a little bit about that from the world of Scott?
Yeah, totally. And Ev, I'll let you jump in as well with your investment bank, because you'll have some insight as well. But with the bond market and how they work, so fixed income, and so you might think, oh yeah, I've got a term deposit, and term deposit rates are rubbish at the moment. But bond markets basically work in a way that the governments are borrowing money to stay in business. And so we always hear about the record amounts of debt in the US and in Australia. And so a lot of developed countries at the moment, and even developing countries, have got large deficits or large borrowings that they've got in play. And so governments are generally borrowing money on those sort of 30-year bases over time. And so the bond market's basically then a guide of, okay, who's borrowing money and what's the cost of that money. The Reserve Bank is then also saying, right, okay, if we're saying lenders can borrow money, what do we think that they should be borrowing money? Well, the same before, when the actual borrowers are then doing their numbers to say, right, how do we make this profitable? They then add their margins and their upkicks to what is going on. Ev, do you want to add anything extra in there before I keep rambling on?
You can keep going.
Keep rambling. And there's interesting, and I mean, I don't know if people can see that, but that's probably, I think, the graph you were looking at or talking about before, Tim, with regards to investor rates versus fixed income rates. And so it is really fascinating that they have just really fixed rates have really increased over time. So again, we're not going to see the full impact of that until people come to refinance those or come off those fixed periods as well. I don't think I've answered your question yet, though, Tim. What was your question again? We may
Well,
go down
no,
round in circles.
you have. I guess. So we know they're based off bond markets, but I guess maybe what has happened with bond markets to make these rates go up so dramatically over the last 6 months?
So it's all again that supply of capital, and again the fact that we've gone through that falling rate. So most developed countries are sitting at those zero interest rates. So again, we saw it in Japan. Like they basically had their issues back in the early 2000s, or not even 90s, I think, and they've basically been at zero interest rates or negative interest rates ever since. So what's happened is that we've gone through that stimulus measure to say, right, we're going to bring down interest rates and cost of borrowing. And then we're now going through that period of, okay, people are spending, and inflation, like the cost of living, as Ev was saying before, is starting to go up. Like we're filling up our cars, if we're buying groceries and day-to-day stuff, that cost has gone up by, in some elements, 7-8%, if not more. Then that is going to have impact on our day-to-day. So basically the market or the Reserve Bank is going, okay, well, we need to now adjust that. The banks with setting their rates, and I think as you said before, sometimes they are doing their numbers to say, okay, where do we think rates are going to land? But the banks basically adjust rates outside of the Reserve Bank anyway. So we saw it when rates were falling. So people listening may remember the dizzy heights. You could put money in a bank account and get a high interest savings account and get 9% before the global financial crisis. And basically since then we've had this falling interest rate market. We might even have people listening or watching that have experienced those 18 or 19% interest rates of the 80s and early 90s. So we see that change over time. But yeah, it is one of those mechanisms that then banks in their own say, right, okay, with their chief economists, with their pricing, like what do we actually see is going to happen in the future? And so that's why they'll then lift up those fixed rates over time. But as that graph was showing, interestingly, investor variable rates and even owner-occupied variable rates probably haven't moved that much. I mean, that's probably something you can comment on, Tim, based on, and Ev, based on your backgrounds with broking at the moment, but they don't seem to have moved much at all.
Yeah, and last year, because where fixed were lower than variable, most people were doing like the entire loan or a portion of the loan fixed. But to your point, yeah, because variable rates haven't moved too much, the differential between fixed and variable is now so significant that at this point in time, most of the recommendations that I have going out are pretty much all variable, because it's a significant difference right now. 1.5%, maybe 2%. So
and that
I think we were talking about the fact that even if you factored in the expected interest rate rises over the next couple of years, you're still going to be benefiting from the variable rate, because the cost difference is going to be still larger if you fix.
And that, again, I often say to people, and Ev, you said it, you hit the nail on the head before, like it is about focus on the stuff you can control. So none of us can control how much cucumbers are going to cost at Coles. Ev, it might be time to, although it's probably the wrong season. No, it's always sunny in Sydney, isn't it? Best season to be doing it now.
Trust me. All I'm going to tell people is Aldi is the best. If you're going to get, if your kids are into fruit and veg, and you can't shop at Coles anymore, come with me and do your shopping at Aldi. It's the best. That's something I can control.
Yeah, exactly. Focus on the stuff you can control. So look at your cash flow and go, right, okay, what is happening cost of living wise? Okay, am I not taking the car as many days a week to work? Am I jumping on an e-scooter or exercising and walking to work if you can, if it's available for you? And even then with interest rates, and I'm not sure what your view is on, well, Tim, on this, but try and repay your loan at a higher rate. So if you're borrowing money now, again, it's not about going, oh, we've heard reports the property market's going to fall by 15% or 20%. that's all smoke and mirrors, I say to people, because look, if you're buying your home, if you're going to be in it for 15, 20 years, you're going to get the money back out of it over that time frame. Sure, you might get hit with initial drop, but over the life of owning that property, you're going to actually make money out of the transaction and out of that. But focus on what you can control. So do your numbers, but make sure you're paying back at I know, I usually say to people, add 2% to the interest rate and make sure you can still make those repayments. And so if you're paying back at a 5% rate, even though you're only getting I know, 3.5 or thereabouts rate at the moment, then that means that you're actually going to be ahead. So if rates do keep going up and then you find yourself in a situation where you do need to cut back expenses, you can reduce that repayment over time. So yeah, anyway.
I think what we need to
I'm rambling again.
I think what we need to do is take bets on how much they're going to increase by tomorrow.
Yeah.
Bottle of wine
Will they go up?
Bottle of wine for the winner.
Okay, I like it.
What's your guess? What's your guess, Tim?
Well, I can't do a range because that's sitting on the fence too much. So I'm just going to say 0.25. I think it'll definitely increase, but just a tweak.
Okay. I'm going to go 0.4.
Yeah.
I reckon they're going to go hard and strong and make an impact straight away and bring the base rate up to 50 bips.
Yeah, wow. Yeah. I like that. I'm gonna sit on the lower side just because we're going through the election cycle. I think 0.15, if I can do that. I'm just going to cut the range. I didn't say I was going to go in the middle, but then no, I'm going to cut the range. But I reckon a smaller rate just because we are going through that slight uncertainty of a federal election process. But yeah, definitely going to go up, I think.
So on crystal balling, I mean, we're just three mates having a chat, so don't hold us accountable. One thing I've learned from COVID is how much there's a bit of a herd mentality. Like, so people react so much to a lot of small changes. So I have a bit of a theory that if they tweak rates, there will be some sort of an impact across the board. But what a lot of people also do is they get scared that rates are going to go maybe not just by 0.2 to 1%, maybe 3% higher, and they start to get really scared about what the future holds. Because what people say is, if you look historically, Scott, rates have been sort of 6 to 7%, but I think it's hard to compare the current cycle that we're in to previous cycles, and that's off the back of what we've seen during the GFC, and that how broadly they got out of it, I think, is this thing called quantitative easing, where the banks, where the government's printed out money and injected money into the system, which has caused this low interest rate environment. So I personally don't see a world where rates are going to be 7%. I think that it'll definitely go up over the next 18 months. Economists are pretty confident on that, but I can't see it going more than 2% over that period of time. Have you got any thoughts on that, guys?
I agree with you. We haven't had a period like what we've experienced recently. So I think that they will keep things relatively manageable. I think when you have a look at the amount of household debt and the level that it's at, if they were to increase it significantly, I mean, that's going to have some huge connotations. And even though we like to say that politics doesn't play a part in it, it does. And I think that, I think like what you just said, it'll be slow and steady. It won't be crazy. But, who can tell? We'll see.
And I agree with both of you. I'm going to come in on the agreement table, but we can't afford it. So I mean, we look back to our parents' generation, and my parents bought their first house in Canberra, and I think they paid about $16,000 or something. But at the time, I think my dad was earning about $9,000, and interest rates were 16 or 19%, I think, at the time when they did that. And so if you look at all those numbers at the moment, sure, our wages are higher, but then the property values are higher, but interest rates are lower. So I think we can't really use, as you said, Tim, economic theory from old, because we are in a totally different like climate and time frame. I still remember when COVID first rolled around, and you had people rolling out going, "Oh, it's going to be like the Spanish flu back in the 1900s," and I'm so like, it can't be anything like the Spanish flu back in the 1900s. We've evolved so much. Like, we're in an information economy. We're on a online world. Like, we're probably all sick of using Zoom and Teams all the time now, but we've seen like that's really elevated. Okay, this is how we work. This is, we can stay connected. We can keep making money. We can keep the system going, even if we're sort of locked down. So we're in a totally different time and economy. So yeah, I think yeah, probably that 2 to 3% rise. But again, it is going to be a long game. It's going to be the next sort of 3 to 5 years on that front. And again, I could be totally wrong. We could have the directors and the board members of the Reserve Bank prove us all wrong. But I think it's going to be that slow and steady approach.
That's good. Ev, in terms of winners and losers, right? So when there's a change, there's people who are hard done by, and there's people that seek opportunity. For people who are out there looking, Scott, we did a chat with Evan, a real estate agent, last week about auctions and how it all works. And Ev's currently out there looking for a family home now, talking about her little journey. But I guess what I can say, like, I've got a lot of clients who, in this last 12 months, it's absolutely been a seller's market, right? So people have been constantly missing out at auctions. They've been going for record prices. Hopefully, the good thing about this next period that we enter is that it should swing back, hopefully, a bit more of a buyer's market, and there should be opportunity out there for people who are in control of their money and who have done, like what you said, Scott, where they've factored in rates increasing, they've got their budget sorted. So hopefully that there should also be some positives out of this next period that we enter. Do you think?
Yeah, definitely. Look, I think, like we've seen before, like history has shown us before these other periods. So we've had many times where we've had buyers markets or sellers markets. So it is just about playing your own game. I think there's often a lot of noise out there, and we do get caught up in the noise because the media loves it. They jump on the media cycle and go, "Oh, this is something that everybody's going to need to know about." And so inflation is that thing at the moment. Cost of living, it hits everybody's back pocket, so they get to ramp it up a little bit more with their spin. But I think play your own game as well, Eva. I know that's a big journey for you. So
let me tell you, it is honestly the reason why I'm drinking a glass of wine every night after getting off realestate.com. But I do feel like the sentiment has definitely changed a little bit. So what I'm noticing now is that a lot of the houses that are coming on are selling prior to auction, because the sellers aren't necessarily looking to go to auction to see where the market really is at for their property. So if they are getting some, decent offers, then they'll actually take the offer. And I think the other thing I've noticed is onto the market, because I think people are trying to make the most of it while the prices are still pretty high, reasonably high. So these are still crossed, my friend.
You'll be fine. I just wanted to say thank you very much for your time. Apologies from mine for the internet issues.
it's been fun.
Yeah, cool. All right. Well,
Thank you.
thank you both for your time. Really appreciate it.
Thanks, Tim. Thanks, Scott.
Thanks, Tim. Thanks, Ev.
Bye.
Bye.